Hello, welcome back. Here is Ali Talabi, and this is our module 10. In this module, we are going to talk about cost of capital. In module 9, we'll learn how to estimate the cash flow, but I promise I'm going to talk about the cost of capital in this module. So in the first lesson, we'll talk about the cost of capital. So I will provide you the notion of cost of capital, and more specifically, we'll talk about something which we call the WACC, or weighted average cost of capital. And I will talk about the components. In the second lesson, I will talk more about the components of the WACC, and more specifically, we'll talk about the cost of equity and cost of debt. So let's start with our first lesson. So in this lesson, the first lesson, we're going to talk about the WACC components and how we measure or estimate the components of the cost of capital. More specifically, I will talk about the WACC itself and what does it mean when we're talking about the weighted average cost of capital, how we determine the weights, how we determine the cost of capital. So let's start the first lesson. So different companies, they use different capital structure, or they have different capital structure. Maybe say, what is the capital structure? Capital structure is the combination of debt and equity. So when it comes to financing, companies, they have a freedom to choose either debt or equity or a combination of those. So when we talk about this combination, it's called capital structure. You have to be careful because we have another similar term, which is called cost structure. The cost structure is talk about the fixed cost versus variable cost. So what portion of your cost is fixed, what portion is variable. This is regarding capital structure, which is referring to your financing structure and what percentage of your financing is coming from debt. And when I'm talking about debt, it might be loan or bonds. And what percentage is coming from equity, which might be the common equity or preferred stock. So in other words, when we talk about the cost of capital, we are referring to something which we call WACC, or weighted average cost of capital, which is the weighted average of the returns demanded by the debt and equity investors. So for sure, when you are borrowing the money, the debt holders, they are expecting some sort of return. When you are getting money from shareholders, your investors, your shareholders in this case are asking for a specific return. So the average return which is expected by those investors, including debt holders and shareholders, it's called cost of capital, or just WACC. Or in other words, we can say the return the firm's investors could expect to earn if they invested in securities with comparable risk. Here we are referring to another important notion when it comes to investment, which is the risk. So cost of capital also is a good measurement of the risk level. So for sure, if the investment has a kind of higher risk, if the company is taking higher level of risk, in this case, we'll see higher cost of capital, or WACC. Now, let's look at the components of the WACC. As I mentioned, different companies, they go with different capital structure. For example, let's assume a company is using 30% debt, 35% common stock, and as you see, 35% preferred stock. So in this case, 30% of total financing is coming from debt, 70% is coming from equity, common and preferred combined. So in this case, we're talking about the capital structure in which 30% is debt, 7% is equity. So the company is more financed by equity. As the percentage of debt is going up, or we are saying the leverage is going up, or the company is using the higher financial leverage. And remember, in this case, the company is actually taking higher financial risk. Why it's a kind of riskier situation? Because we know when it comes to debt holders, you have to pay interest to the money that you borrow from debt holders, including the loan or the bonds. So if you are not able to pay the interest or the principal, which is the original money, in this case, there is a high chance of bankruptcy or default risk. And this is a very risky situation for the company. That's why we are saying you are taking the risk. But when it comes to equity holders, If you don't have money, if you don't generate income to pay dividends, for example, to your shareholders, most of times that's fine, that's totally fine. In a specific case, when we're talking about the preferred shares and those type of preferred shares which you have to pay, you might end up with some challenges. Anyway, preferred shareholders, the risk is even less than the debt holders. So again, the major focus or the major challenge comes from debt when you are not able to pay back your debt or associated interest. Now, let's look at this example, which we have here. Usually we use the market value of assets, shareholders' equity, and debt to determine the weights when it comes to weighted average cost of capital. If you don't have the market value, in some cases you might use the book value. And this is very common for debt. However, for the shares and for the assets, it's much better to use the market value. So in this example, you see the market value of the assets is $500. The market value of debt is $200, and the market value of equity is $300. So in this case, we can say the company is financed 40% from debt and 60% from equity. How we calculate that? Simply, you need to divide the value of the debt by the total value of the assets. So you divide $200 by $500 to get 40%. And same for equity, you divide $300 by $500 to find the weight of equity in the capital structure of the firm. So again, remember the WACC is the weighted average of the returns on debt and equity, and weight highly depends on the relative market values of the securities. So we are using the market value of debt, we are using the market value of shares, and in some cases, if you don't have the market value, you might use the book value. For debt, we are less concerned because usually the market value of the debt and the book value is very similar, very close. However, when it comes to shares or equity, we'll see the market value is substantially different than the book value. It's much better to use the market value. One major note when it comes to WACC is if you're using the debt in your capital structure, actually, it's kind of beneficial to your firm in a way that you will pay lower taxes. So we learned before that the interest payment on debt works as a tax shield. What does it mean? It means it reduces the amount of the tax you are paying. So you will have the interest tax shield. So the cost of debt, when it comes to cost of debt, you should include the tax rate. What does it mean? It means you should go with the after-tax cost of debt. So you need to consider the tax saving when it comes to the debt and just the debt. What's the implication on WACC? Remember, the impact on WACC will be positive. The cost of capital will be lower when you have interest in your payment, and it means you are paying lower taxes. So the tax payment lowers your cost of capital. That's the implication. So can we apply the same argument to equity and the dividend? No, because you pay dividend after paying out all the taxes. Dividends are not expenses, so you cannot use dividend to claim expenses to reduce the amount of taxes. So we know that's a part of retained earnings. And you are paying dividends out of your net income, which you already deducted the tax from your income. So remember, just the only component in the cost of capital which you can apply the tax, which you can actually deduct the tax is debt. So you cannot do that for the equity. Now let's put all the pieces together. You have the debt, the percentage of the debt, you have the cost of debt, and also you have the percentage of equity and cost of equity. So the weighted average cost of capital is based on those numbers. So as you see, WD is showing the weight of debt, or in other words, that the debt to asset ratio is showing what is the percentage of debt in your capital structure. You see, just I'm applying tax to the cost of debt, so you need to go with after-tax cost of debt. So it's 1 minus T times D. That's the first portion of your cost of capital. The second portion is regarding the equity. You have the weight of equity and you have the cost of equity, or in other words, you are multiplying the equity to asset ratio by the cost of equity. As I mentioned earlier, it's much better to use the market value of the cost of capital components. So for the debt and equity, we should use the market value. If we don't have the market value, we might use the book value as approximation. This is more reasonable for debt because we don't see much differences between the market value and the book value of the debt. But for equity, the difference might be much wider. And remember, as we mentioned earlier, the interest is a tax deductible item. So since that's the case, it means we need to include the after-tax cost of debt. This doesn't apply to the cost of equity because cost of equity is based on the equity and you are paying dividend, and dividend is not an expense, so you cannot include that in the cost of capital. So based on this argument, let's look at an example and see how actually we calculate the weighted average cost of capital. So in this example, let's assume the company pays 12% for debt. So your cost of debt is 12% and 15% is the cost of equity. The tax rate is 30%. And the capital structure is formed in a way that 40% is financed from debt and 60% is from equity. So we already know the formula, just you need to plug the numbers, use the WACC formula. As you see, based on this argument, I'm just applying the 30% tax rate to the debt portion. And in this case, the weighted average cost of capital becomes almost 12.4%, just about 12%. That's your average cost of capital. And for sure, you see that the cost of capital is much better than the cost of equity. That's always the case. For sure, the weighted average cost of capital will be lower than the cost of equity. So this is the session for today. So next lesson, I will talk about the components of the cost of capital and how we actually calculate the cost of equity and cost of debt using different approaches. Thank you very much. Here is Ali Talawi. Have a wonderful day. Talk to you soon. Take care.